Okay, so how do we... It's very easy to understand how we're going to take the first day breakout trade. You're taking it on a breakout. The dip buy, I'm not so sure. That needs a bit more investigation. Perhaps a moving average. You'd have to be quite a shallow one because you haven't got that much data. Or perhaps something like, a lower low or a volatility expansion or something to give you a clue that is tailing off. But look at the pattern here. That little consolidation before the rip up. You look at Twitter, almost identical. Consolidation before a rip higher. Alibaba, GoPro consolidation before a second leg higher. FITBIT not so much, but you still got that blast up. Facebook was a different story altogether. It was overpriced genuinely. And Zynga, again, little consolidation before a rip higher. So there's something to be said about both of those strategies. So how do we exit these trades? Well, this is with a further optimization and something, if you like the idea of this, you can go away and do something yourself. I'm going to do some myself. I think you've got a couple of choices here. You either say to yourself, right, you know what, we're getting a likelihood of 2 times R, 3 times R, 4 times R, etc. So what I'm going to do is I'm going to scale my position as it goes 2 times my risk, 3 times my risk, 4 times my risk, whatever, and have a structured way of scaling. I quite like that idea. Another way of doing it is to say, okay, I'm going to go for all or nothing 10R, 20R plays. So as we maybe move to twice your risk, you pull your stop to break even. Okay, now I know there's a bit some controversy around doing that. However, if we're looking for this sort of 10, 20 times risk play, then at some point we're going to say, well, I'm going to get stopped. At what point do I tighten my stop up? Do I start to ratchet it? Maybe I pull it up a little bit tighter and put 1R when it goes 3R. Again, that's up to you, and I think you're going to have to adjust that to suit the volatility of the stock. But the broad idea of that is to kind of trail the stop up, looking for a huge move. Because if you go back to this table here, you can see that there are times when you're getting 10, 20, almost 30 times your risk. So even if you got stopped out at break even or a small loss on a couple of them, then when you do get on the end of one, you're talking about a nice profitable trade. And actually, when the supply-demand imbalance goes like this, it's interesting. This is when you get a catalyst that you will get that big move. Okay, so that's that. And different exit criteria, as like I say, trail, maybe ratchet a stop up, maybe using a stop for the whole day's range rather than the half day. Again, just trying to work a decent strategy around it. And then maybe looking a bit more interesting in terms of hype of the IPO. Is it really hyped up one? How much are they raising? How many shares are in issue? Perhaps that influences things. And also the country of the IPO. I've just done US stocks because I think that, generally speaking, Americans prefer to own stock than Europeans or British investors, traders. So perhaps that adds a bit more fuel to the fire. But again, something to look at. The 2 to 4 week dip buy, that's good. And another thing to look at is investigating the return from X days from the first day's close. So perhaps if you're a number cruncher, you can input the data and say, okay, well, if I buy 10 days, is that better? If I do it very systematically, what's the sweet spot from it? But there's definitely a strategy in play there. I'm going to be allocating some capital to this strategy moving into the new year. It fits in with the kind of swing trading approach and special situation approach for me. I like it. Eyeball, it looks good. Rough statistics, it looks good. And so I think the first day breakout is a good trade, as is that kind of 10 to 20 day dip buy. So going to be looking out for those. Hopefully there'll be a lot of IPOs this year. Hopefully we'll get some volatility and it'll be a great trading year.